What is the depreciation recapture rules when selling rental property? Have you ever wondered what happens to the tax benefits you received from depreciation when you sell your rental property? This is a common question for many small business owners and landlords. Let's break down the depreciation recapture rules that come into play when selling rental property. When you purchase a rental property, you establish a cost basis, which is usually the purchase price plus any acquisition costs. Over time, you can claim depreciation deductions, which reduce your taxable income. However, when you sell the property, the Internal Revenue Service requires you to recapture some of those benefits. This means you may have to pay taxes on the depreciation you previously claimed. First, let's talk about the adjusted cost basis. This is your original cost basis minus the total depreciation you claimed. For example, if you bought a rental property for $100,000 and claimed $54,540 in depreciation, your adjusted basis would be $145,460. Next, when you sell the property, the gain on the sale is calculated by subtracting your adjusted cost basis from the selling price. If you sell the property for $280,000, your gain would be $134,540. Now, here comes the important part, the taxation of depreciation recapture. The portion of the gain that comes from depreciation deductions is taxed at a maximum rate of 25%. This is higher than the typical long-term capital gains tax rate. The Internal Revenue Service treats this recaptured depreciation as ordinary income, but they cap the tax rate at 25%. Any gain above the depreciation recapture amount is taxed at the standard long-term capital gains rates. These rates depend on your income and filing status. If your income is high, you may also face an additional 3.8% tax on investment income, known as the net investment income tax. It is also essential to note that if you sell your rental property for less than your adjusted cost basis, the depreciation recapture rules do not apply. In this case, there is no gain to recapture, and you will not owe any taxes on depreciation. To summarize, when selling rental property, the depreciation you claimed reduces your cost basis. Upon sale, the Internal Revenue Service recaptures depreciation by taxing that portion of the gain at up to 25%. The remaining gain is taxed at capital gains rates. Understanding these rules is vital for effective tax planning, especially for small business owners who may be utilizing a home office deduction. Always consult a tax professional for personalized advice based on your specific situation.